Old money didn't just survive, it thrived. Families like the Rockefellers, Rothschilds, and Vanderbilts built wealth that lasted for generations. But how did they do it? What were the strategies that allowed them to not only create wealth, but also preserve it for centuries? And here's the big question. Can we use those same strategies today to achieve financial freedom and generational wealth? In this video, we'll walk through the top 10 ways old money was invested, and more importantly, how you can apply these timeless principles in today's world. Whether you're just starting your financial journey or looking to secure your wealth for future generations, this is the video for you. Let's dive in. Number 1. Real estate. First on our list is one of the oldest and most reliable forms of wealth creation, real estate. For centuries, land ownership has been the cornerstone of generational wealth. Take the Rockefeller family, for example. In the late 19th and early 20th centuries, they purchased vast tracts of prime real estate, including properties in Manhattan. Over time, these properties not only provided steady rental income, but also appreciated in value significantly, creating a reliable and growing source of wealth. Why it worked. Here's why real estate works so well. Land is a finite resource. It has intrinsic value, provides income through rents or farming, and tends to appreciate over time. Plus, it's tangible. You can see it, touch it, and use it. That's why old money families made real estate a cornerstone of their portfolios. Will it work today? Absolutely. Real estate is still one of the best ways to build and preserve wealth. But today, we need to account for factors like property taxes, zoning regulations, and market fluctuations. The key is to buy strategically. Look for properties in growing areas or those that generate consistent cash flow. How to use it today. If you're not ready to buy property outright, consider investing in REITs, real estate investment trusts. These allow you to invest in real estate without the hassle of owning and managing properties directly. Whether it's residential, commercial, or agricultural real estate, there's always an opportunity to grow your wealth through property. Number 2. Family trusts. Next on the list is a tool that's less tangible but just as powerful: family trusts. If there's one thing old money families knew, it's that protecting wealth is just as important as building it. Take the Rothschilds, for example. This family used trusts to ensure their wealth was managed and passed down efficiently across generations. Trusts protected their assets from taxes, mismanagement, and disputes among heirs. Why it worked. Family trusts work because they provide control. They allow you to dictate how your wealth is distributed, protect it from creditors, and often reduce tax burdens. It's like having a financial safety net for your family's future. Will it work today? Absolutely. Trusts are still one of the best tools for preserving wealth. However, they require careful planning and professional management to comply with modern tax laws. How to use it today. If you want to set up a trust, work with an estate planning attorney. You can choose between revocable and irrevocable trusts, depending on your needs. Trusts are especially useful if you want to ensure your wealth is passed down responsibly. Number 3. Blue chip stocks. Now let's talk about something a bit more modern. Blue chip stocks. These are shares in well-established, financially stable companies with a history of consistent performance. The Vanderbilt family, for example, invested in companies like General Electric during its early days. These investments provided consistent dividends and grew in value over time, helping the family maintain their wealth. Why it worked. Blue chip stocks work because they're reliable. They provide steady dividends, long-term growth, and are typically less volatile than other investments. They're the backbone of any solid portfolio. Will it work today? Yes, but the key is diversification. While blue chip stocks are relatively stable, no single company is immune to market changes. That's why it's important to spread your investments across sectors. How to use it today. Consider investing in index funds or ETFs that track blue chip stocks. This gives you exposure to a broad range of companies without the need to pick individual stocks. It's a simple, effective way to grow your wealth over time. Number 4. Cash crops. Next up is a strategy that goes back to the roots of civilization: agriculture. Old money families often invested in cash crops like cotton, tobacco, and sugarcane. The DuPont family, for example, owned vast agricultural lands that produced consistent income. Agriculture was not only essential to the economy, but also provided a hedge against inflation. Why it worked. Agriculture worked because people will always need food and raw materials. It's a stable, income-generating asset that's less tied to market fluctuations. Will it work today?
Yes, but modern investors need to consider factors like climate change, regulations, and the volatility of commodity prices. How to use it today. Invest in farmland or agricultural ETFs. You can also look into agribusiness companies that produce essential goods. Number 5. Precious metals. Gold and silver have been symbols of wealth for centuries, and for good reason. Precious metals are a hedge against inflation and economic uncertainty. European aristocracy, for example, stored wealth in gold and silver during times of war and economic instability. These metals retained their value when currencies and markets collapsed. Precious metals work because they're tangible, durable, and universally recognized as valuable. They don't rely on any government or financial system to maintain their worth. Will it work today?
Yes, but they don't generate income and can be volatile in the short term. They're best used as a hedge in a diversified portfolio. How to use it today. Buy physical gold or silver, or invest in ETFs and mining companies. Be mindful of storage costs and market trends. Number 6. Government bonds. Next on our list is one of the safest and most stable investments old money relied on: government bonds. These were a go-to strategy for families looking to preserve wealth while earning steady income. Back in the 19th and early 20th centuries, wealthy families often purchased government bonds as a reliable way to grow their wealth. For example, during times of economic instability, families like the Morgans allocated significant portions of their portfolios to government bonds, which provided consistent interest payments without the risks associated with other investments like stocks or real estate. Why it worked? Government bonds worked because they were, and still are, considered one of the safest investments you can make. When you buy a bond, you're essentially lending money to the government in exchange for regular interest payments and the return of your principal upon maturity. Governments rarely default on their debt, so bonds became a cornerstone for wealth preservation. They provided a predictable, low-risk income stream that allowed old money families to maintain their wealth while avoiding unnecessary exposure to volatile markets. Will it work today? Yes, government bonds are still an excellent tool for stability and income, but there are a few things to keep in mind. In today's low interest rate environment, the returns on bonds may not be as attractive as they once were. Inflation can also erode the purchasing power of the fixed returns bonds provide. However, they remain a critical component of a diversified portfolio, especially for those who prioritize safety and consistent income. How to use it today? If you're looking to incorporate government bonds into your portfolio, there are several options to consider. First option, Treasury bonds. Issued by the federal government, these are among the safest investments available. Second option, municipal bonds. These are issued by state or local governments and often come with tax advantages, making them attractive for high-income individuals. Third option, bond ETFs. If you don't want to buy individual bonds, bond-focused exchange-traded funds, ETFs, allow you to invest in a diversified basket of bonds with ease. The key is to align your bond investments with your financial goals. For example, if you're nearing retirement and want stability, bonds can provide a steady income stream. If you're younger, you might use bonds as a way to balance riskier investments in your portfolio. Government bonds may not be the most glamorous investment, but they're timeless for a reason. They offer security, predictability, and peace of mind, something every investor, old or new, can appreciate. Number 7. Infrastructure investments. Let's move on to another classic investment strategy that helped old money families grow their wealth: infrastructure investments. Back in the day, this often meant putting money into railroads, canals, and other essential infrastructure projects. Take the Astor family, for example. They were early investors in the railroad boom of the 19th century. Railroads were the lifeline of economic growth, connecting cities and enabling trade like never before. By investing in these projects, the Astors not only earned steady returns, but also positioned themselves as stakeholders in the economic development of their time. Why it worked. Infrastructure investments worked because they were tied to the backbone of economic growth. Railroads, canals, and other infrastructure projects were essential to transportation, trade, and industrialization. These investments provided consistent income through tolls, fees, or dividends, while also appreciating in value as the economy expanded. Will it work today? Yes, but with a modern twist. Today's infrastructure investments look a little different. Instead of railroads and canals, we're talking about highways, airports, renewable energy projects, and even digital infrastructure like data centers and fiber optic networks. These are the building blocks of today's economy, just as railroads were in the 19th century. How to use it today? There are several ways to invest in infrastructure today. Infrastructure ETFs or mutual funds. These funds invest in a diversified portfolio of infrastructure-related companies and projects. Direct investments. For high net worth individuals, direct investments in renewable energy projects or public-private partnerships can be lucrative. REITs focused on infrastructure. Real estate investment trusts, REITs, that specialize in infrastructure assets like telecom towers or energy pipelines can offer steady income and growth potential. Infrastructure investments remain a powerful way to grow wealth while contributing to the development of essential services. Number 8. Art and collectibles. Now let's talk about a more creative way old money preserved their wealth. Art and collectibles. This isn't just about paintings. It's about investing in unique, valuable items that appreciate over time. The Medici family, one of the wealthiest families of Renaissance Europe, were patrons of the arts. They didn't just commission masterpieces, they also collected them. Over time, these works of art became priceless assets, not only preserving their wealth but also enhancing their legacy. Why it worked. Art and collectibles worked because they're unique and scarce. A Picasso painting or a rare coin doesn't just hold value, it often appreciates significantly over time. These assets are also less correlated with traditional markets, making them a hedge against economic downturns. Will it work today? Yes, but investing in art and collectibles requires expertise and patience. The market can be illiquid, and values can fluctuate based on trends, demand, and the authenticity of the item. However, the rise of fractional ownership platforms has made it easier for everyday investors to participate in this space. How to use it today? If you're interested in art and collectibles, here's how to get started. Blue chip art funds. These funds pool money from investors to purchase high-value artwork. Fractional ownership platforms. Platforms like Masterworks allow you to buy shares in iconic pieces of art. Collectibles. Markets. Whether it's vintage cars, rare wines, or sports memorabilia, focus on items with proven demand and authenticity. Art and collectibles aren't just investments. They're a way to preserve culture and create a legacy. Number 9. Private equity, ownership in businesses. Next up is a strategy that's all about taking ownership, private equity. This involves investing directly in businesses, either by starting them or buying into existing ones. Take Andrew Carnegie, for example. He didn't just invest in steel, he owned the steel industry. By reinvesting profits and maintaining control, Carnegie created one of the largest fortunes of his time. Why it worked. Private equity worked because it allowed families to participate directly in the growth of businesses. Unlike stocks, private equity investments often come with higher risks but also higher rewards. By owning a business outright, old money families could control operations, reinvest profits, and build long-term value. Will it work today? Yes, but private equity is no longer limited to the ultra-wealthy. Today, there are more opportunities for everyday investors to participate, though these investments still carry significant risk and require due diligence. How to use it today. Here's how you can get started with private equity. Invest in startups. Platforms like AngelList or Seed. Invest allow you to invest in early-stage companies. Private equity funds. These funds pool money to invest in established private companies. Small business ownership. If you have the skills and resources, owning a small business can be a lucrative way to build wealth. Private equity remains one of the most direct ways to grow wealth, but it requires careful planning and a long-term perspective. Number 10. Shipping and trade. Finally, we come to a strategy that helped build empires: shipping and trade. This was the lifeblood of global commerce for centuries, and old money families were quick to capitalize on it. Take the British East India Company, for example. This wasn't just a company, it was a global trading powerhouse. By controlling shipping routes and trade goods like spices and textiles, they created immense wealth for their investors. Why it worked? Shipping and trade worked because they were essential to the economy. Controlling the movement of goods across the world meant controlling wealth. These investments provided consistent income through trade profits and dividends. Will it work today? Yes, but the modern equivalent might look a little different. Instead of owning ships, today's investors might look at logistics companies, e-commerce platforms, or supply chain technologies. How to use it today? Here's how you can participate in this space. Logistics companies. Invest in companies like FedEx, UPS, or Maersk that dominate global shipping. Shipping ETFs. These funds focus on the shipping and logistics sectors. Supply chain technology. Companies that innovate in supply chain management are becoming increasingly valuable in today's economy. Shipping and trade remain vital to the global economy, and there are plenty of ways to get involved in this sector. And there you have it, the top 10 ways old money were invested to last generations. From real estate to railroads, from art to private equity, these strategies weren't just about making money. They were about preserving it, growing it, and passing it down. The good news? These principles still apply today. With the right knowledge and a long-term mindset, anyone can use these timeless strategies to build wealth that lasts. Remember, building wealth isn't about chasing trends or getting rich quick. It's about making smart, thoughtful decisions that stand the test of time. If you enjoyed this video, give it a thumbs up, share it with someone who needs it, and don't forget to subscribe for more insights on building wealth and achieving financial freedom. Thanks for watching, and I'll see you in the next video.